Welcome to Investing in Startups. Our guest this week is Jason Freedman, serial founder and general partner at Orange Collective. Orange Collective is a Y Combinator focused venture fund that it aims to invest in the most promising YC companies before demo day. We talked about YC, exits, AI, open source, raising founders up, and why ownership percentages are overrated. Please enjoy. Jason, thanks for coming on the show.
Happy to be here.
What was the defining moment that you had as a founder that shaped how you think about investing?
I had my first company acquired against the recommendation of Paul Graham. And lots of people have gone against PG's recommendations at times, and it generally doesn't turn out well. So we had this, it was kind of a middling company. Like, we weren't building anything impressive, and we got tucked in on this acquisition, which wasn't really an acquisition. It was more of an acqui-hire, but I'd had zero success before, and I had $0, and there's no way I was going to pass it up. 3 months into the acquisition, I'm fighting with everyone, and the CEO of the company hates me, and I hate him back, and I find a way to get myself fired. And, it's pretty uninteresting what went on in that little palace intrigue of one floor of one random building. But the reality was, it was 3 months in an acquisition. I'm fired. I lost everything that I just got. I'm escorted out of the building. I'm 31.
Did you have a box with you, or did they tell you they'd send you your stuff?
Just said your friends will bring your stuff to you later.
Okay.
And I was dating a girl who's now my wife, but she's got a father. I'm trying to impress a father-in-law. This wasn't fun. I'm wild. I can do anything. This was the dumps. And I'd had in my head, if you don't start something by the time you're 30, you're probably not going to start something. And that's 100% totally false. But it was kind of the thing I had in my head. And now I'm 31. And the one time I found a smidgen of success, now that's turned into a failure too. And it's just me fired. The rest of my team is still there. And they're not marching out after me. And I go back to this super sad hotel room. I don't really know who to call. I talk to my brother. I talk to my parents. I tell Jen. It's really awkward. And I send an email to Paul Graham, and I said, "You were right. They just fired me. I should have never done it." And he calls back almost instantly. And the first thing out of his mouth is, "What's something that annoys you about the world?" And so I start to tell him about how annoying it was about this and that and he's like, "No, that's not what I'm asking. What's something annoying about the world that you want to fix?" And I'm like, oh, yeah, this moment is taking me to school. And I start to give a derivative of the idea of the last company, which was a travel analytics company. I have something else in travel. And he's like, "It doesn't seem like you really care about that. What's something in the world that annoys you that you want to fix?" We're 45 seconds into this conversation. And I'm whenever I search for office space, it's super annoying that the brokers take me around and I can't even see what's inside it or even have a choice of what I get to see. And he's like, "So you'd want to see a picture of the inside before you take the tour?" And I'm like, "Yeah, that sounds like table stakes. And it should be more like searching on Redfin or Zillow." And he goes, "You want to make it easy for people to search for office space. Go spend 6 months becoming the world's expert on that subject, and then come do Y Combinator again. I'll fund you." The whole conversation lasted 90 seconds. The whole thing. The next 10 years of my life were 42 floors. We built Zillow for office space. At my lowest moment, he lifted me up, and he never said a nice word or an empathetic word. He never got on my side. He just got me to the next play. And I legitimately think if I didn't come up with a good idea, He would have just told me it was a bad idea. and there wouldn't been of like, we'll fund you. There's some people who they're so honest with their feedback that the honesty becomes like like an absolute. And that's Paul Graham is that way with honesty. He also never tears anyone down. So I had just gone against his recommendation. And he never did an I told you so, or should we talk about how? Like he never tears someone down. So there's a thing that PG did that he then forced very explicitly other people who would go on to work for Y Combinator or who would become alumni helping other founders, which he said, you must be honest and you must build them up. And that combo, I don't know anyone in the planet that's as good as he is. And I don't know anything. So let me see, is this an absolute statement? I think in terms of how Y Combinator acts, I don't know if there's anything as important in the ethos as we give honest feedback and we build people up.
I respect that. I've run into situations, and I'm curious for your feedback on this, where as a manager, you might have a big team, you have someone who is maybe for whatever reason they're on the team and not an awesome performer. Maybe it's not for a lack of hustle, but their ceiling as a contributor may not be all that high. I'm sure you've run into that at some point. How do you handle a situation like that as far as trying to do both of those things at once, being honest, but trying to lift them up as well?
I mean, I think being honest and lifting people up. Notice he didn't do the Oreo method. He didn't say, here's a good thing, here's a thing you need to work on, and let me finish with a good thing. He didn't do anything like that in his story with me. The feedback is brutally honest. And I think you just have to actually believe in people's potential. So like one thing in your little sentence there was their ceiling might not be that high. I would question whether anyone has arbitrary ceilings to them. I think they have various levels of capabilities and they might be in like the wrong place. They have various things that they've learned or need to unlearn. They have psychological issues which like prevent them from reaching their full potential. But I have like a very optimistic view on people and technology and innovation and the world. I mean, I'm a big optimist about the world. And I think it shines through when I talk to people. And I say that as someone where I think if we were to, survey anyone who's ever worked for me and said, do you like Jason? I think there's a large number that don't. Because my feedback's brutally honest and it's very hard to stay hired with me. I don't necessarily I'm not a fluff ball, but I'm a very positive, intentioned person on people. And I will say this about my startup feedback when I've met with entrepreneurs. Learning how to be positive, to be honest and build them up is a learned behavior. It's very, very challenging. And when I think back of many of the entrepreneurs I've talked to in different phases of my career, if I see one progression across my advice is I've learned through effort to tear them down less. And when I see recent entrepreneurs, either like just gotten to the phase where someone wants their advice, the number one thing I see is they are free with the advice, but they don't build people up. If you think of PG tapping Michael Seibel and saying Michael Seibel is a special human being to be a leader of Y Combinator for so long, Michael Seibel is brutally honest in his feedback and is probably the most uplifting person anyone's ever interacted with. I think that's like the prototypical YC group partner is to be like Michael Seibel.
What else have you learned from being on the investing side of the table that wasn't obvious to you when you were a founder?
In over 99% of founder investor relationships, the founder over-indexed the value of the advice. And I say they over index it for a few different reasons. Founders are so alone, like, especially if you're a young founder or first time founder, and you need to raise capital, and the capital is generally, except for like a few rare cases, in like more short supply than the demand for the capital. The people who give capital have done something. That thing might be they just raised capital and they can afford to give it. It might be that they ran a company. But that capital seems to come with advice. And I think founders dramatically over-index the value of that advice. And so what happens over the course of having investors over a long period of time is there's kind of a continued shock that this wasn't good advice. And let's just like unpack why that advice is over-indexed. I'm not saying it's bad or malicious, though sometimes it is, but it's just over-indexed. Let's take the most innocent one. It's like superstar, successful founder becomes an investor. If you are building an important company, it's important because the world did not see it coming. And for some reason you did, and possibly by accident, right? You could be Air Bed and Breakfast who's pivoting into Airbnb. So like the world didn't see it coming. Paul Graham did not understand that Air Bed and Breakfast was going to be a good company to invest in. Jessica thought the founders were good. That's why they invested. So you can have the most brilliant investors in the world, but they just might not see the world that's uncovering. Now that's fine. You and the investors might be in the same place, both not seeing this like important new thing that's about to occur. However, the investor's giving advice and you're choosing to take it, and you over-index the correctness of it, when instead you should have used it as just a single data point, no more important than any other data point. But because they're an investor, it's imbued with this like importance. And so you chose to think that this is good advice. Okay, so now you're biased in your own like exploration of your problem and what you should have been learning only from users. And now you've got this like piece of advice that's important. But now this advice has certain biases to it. And the most common one, totally not malicious, is investors were successful in a different era. And so they bring with them something they learned, pattern matching from their era, but you are inventing a new era. And so I remember all my most famous investors at 42 Floors, they all had advice that came from like the ethos and the playbook of their time. And I started to see, oh, you like always go back to how things worked. You lived in the SEO age, and so you think SEO is super important. Or you lived in the beginning of the SaaS age, so you think SaaS is super important. And you have all these like opinions. Some investors come out of growth at all costs, and some do blitz scaling, and some are like, no, it's profits only. So they have all these like things, and it's just based on the pattern they come from, which the most important thing about that pattern is it's not today. And brand new important companies always invent something new that the previous set of players didn't understand. Otherwise, they would have already done it. So that's our second problem. But now we get to the third one, which is investors have different goals. And here we run into a lot of problems. And now we get into investors need a markup on their previous investments so that their fundraising goes well to their LPs. Investors need to deploy a certain amount of capital, so they need to increase your valuation in order to put that capital in. Investors are going to vote their shares in the end. Investors are going to wait until the value of the company falls in order to recap the company and buy up their ownership percentage. Investors care about what their partners think about them. And so whatever happened, some other random deal is now affecting how they treat you. Investors care about personal attribution and whether they were the ones who sourced this deal affects whether they want to put more capital into it. Like there's this long list, but they never say it. And this is now the advice giver who probably many, many, many times was giving advice earnestly is not saying that right now in this moment that advice is biased because they have an ulterior agenda. And now you really get into like endpoint inflection moments where the entrepreneur's just getting not advice that's in their best interest personally, not necessarily the company's best interest in terms of like expected outcome. And now you really see, the breakup between the entrepreneur and their investor at the end of the company is so common because it's the time in which the chips really matter where they land. And this advice giver is just leading them down a direction they don't want to go. So again, coming back to Y Combinator and why it's so unique in the world, Paul Graham started it and ran it for years this way, where he took common stock. He just wanted to get rid of one of the reasons investors and founders are not on the same page. So he took common stock. No other rights to that common stock either. Like you can literally, in those first many years of Y Combinator before they changed it over to preferred, he just said, we're like co-founders. Not only are we like co-founders, you can fire us as co-founders. We're not even vested. You can recap. And that alignment took out one bias. The second thing, that second piece of bias on how they're like operating with different patterns, Y Combinator was very clear in its advice that you are not here to take our advice on what to do. We just have certain things we've learned from you. Like, what have you learned from your users in the past week that you didn't previously know? And how should that affect what you should do this week? That's a classic Y Combinator question. Make something that people want seems to be the right goal. But YC would always be asking, like, maybe something's different. Like, for years, PG used to say, come up with a way to say that your company is X for Y. And I remember at a dinner, he was like, you know what? On our biggest winners, they don't match X for Y. So we have to stop saying that because it works most of the time, but not in the most important times. So he had this like super intellectual honesty to his own advice. And then in terms of like, our first biases, we're working backwards. YC kicks you out of YC between Tuesday evening and Tuesday morning. So YC would not let its advice become super important. They wouldn't let themselves run the company for you. Famously, Paul Graham told the Airbnb founders on Tuesday night, where are you getting most of your good feedback? And it was from their users. Where are their users? They were in New York. And so Wednesday morning, he told them to go fly to New York and live with their users from Wednesday to Monday and then fly back. All of their Y Combinator experience was just a Tuesday afternoon meeting and a Tuesday afternoon dinner and then fly back to New York. So Y Combinator like took to heart really this like ability to be influential in super important ways without guiding the entrepreneur with advice. As I've become an investor, it's hard to reach that level. It just really is. And one of the things I found when I was leading rounds is I didn't enjoy it as much. So when I would lead a round and take a board seat, I personally found I didn't like that role as much as I did when I was angel investing.
Because you had to be the bad cop sometimes?
Well, and I had to wear a hat, and I had to say, all the time, right now I'm wearing my preferred investor hat, or right now I'm wearing this hat. And, I try as hard as I could to say like this hat, this hat, this hat. I started to feel schizophrenic about it. Orange Collective, the fund that I do now, which is a whole bunch of YC alumni and non-YC alumni that we invest in YC companies, and we kind of try to do it the YC way. We write a 300 to 600K check. It's enough to be materially valuable. It's not a lead check on purpose, and it doesn't take a board seat. And it was just my way of saying, how do I enjoy interacting with founders? And it's as close as possible to the Y Combinator way, which is removing as many of the reasons we would ever not be on the same page. And, it's not a right or a wrong thing. It's just our preference of where we are. The investors who come after us, who put $10 million into the company, I'm really appreciative of them. And they have to do a lot of work with that 10 million. And hopefully that 10 million leads to many tens of millions more. Our good friend Dan Levine led Scale AI's lead round, and he put 4 million into that round in 2016. I think Excel has now put in something like 250 million total into Scale AI, some crazy number like that. I would expect his role as a board member on Scale AI doesn't just get to be, I'm rooting for you, founder, and I always have your back. Like, he has to wear different hats. So I'm like really respectful and appreciative of those investors who do that. For us personally, it's just pure enjoyment to like put 300 to 600K into a founder and root for them.
So I know you said that founders over-index on advice from investors, but as someone who's exited 2 companies now that you started, what advice do you have for founders on the dismount, on the exit?
Founders, too late in their own process, think openly and honestly about how exits work. I think it's like they're stunningly unprepared. Pretty much across the board in both good outcomes and bad outcomes, stunningly unprepared. If the startup ecosystem, in large part led by Y Combinator, has spent the last 20 years teaching founders how to raise a seed round and a Series A, where like now first-time founders run into those rounds and like they're ballers and the documents are standardized for them and all the like malicious terms have like been pushed out of the way, and you're branded an awful investor if you introduce participating preferred or tranches, and the founders know exactly how these terms work, and generally like seeds and Series A go well. Like most people I know who raise a Series A don't have war stories from that Series A. They have maybe their like moments of triumph and whatever, but like it's kind of like a fair game. In fact, I think many investors complain it's not even fair to them. It's, the valuations are too high and these companies aren't worth it or whatever. But, I look at the returns of those funds and they're still pretty good. So maybe it's all just kind of neutral. M&A is not that way. M&A is a slaughter fest and the founders are horrible at it. All situations. So why is it that founders are unprepared for their M&A? And they're unprepared in all the ways. They don't know how the terms work. They don't know how the money is distributed. They don't know how long it takes. They don't know how to control the moment. They get screwed in like lots of different ways that they had to like anticipate that was going to happen in order to prevent it. And they don't get good advice along the way. So they're not like leaning on, a set of resources. And it's really surprising to me that we haven't all gotten better. Like, I'm not going to sit here and list off 10 great blog posts you need to read or this book that covers it all. Like, M&A is not covered by anyone. There's no vendor industry saying, hey, we help you with M&A. That's materially accessible to, the bottom 99% of M&A. Most investors are not good at helping their founders with M&A in all the ways. They're not aligned with the outcomes. They're not materially involved in the actual nitty-gritty of it. During my acquisitions, they were absolute shit shows with all sorts of problems that went down. And I remember going to John Levy, the head of legal for Y Combinator, and I was like, I'm so sorry, that was so awful. And he was like, they're all like that, every single one. And I was like, there's no way. That was worse than anyone's ever been through. And he goes, that was baseline median. And now that I've helped a whole bunch of entrepreneurs through their acquisitions, I'm like, it's the same. Stunningly unprepared. So back to this question, why are they stunningly unprepared? I think it's harder to talk about what to do during M&A. A lot of that stuff, people don't want to share like stories with names. I think founders are misguided by having succeeded at funding rounds. Extremely misguided. They've been through financial transactions with big sets of docs, with leverage that has to be monitored. and they become accustomed to a couple of things that they think are truths, which is when you get to a term sheet, the term sheet's probably going to be pretty close to the end. To pull a term sheet is so awful that no respectable institution would do that to their reputation. Final docs should mirror term sheets relatively consistently. Maybe you get irritated by a term here or there. And final docs are trustworthy. Like those are a set of just truths that entrepreneurs are used to from their seed, Series A, B, C, whatever. M&A is not like that. I mean, no one cares about their reputation in M&A. M&A is absolutely brutal. Term sheets get pulled, definitive docs change dramatically. Prices can shift 40% in the last day, especially, in the post ZERP moment when M&A became more rare and thus the acquirers, their leverage went way up. I would say most deals that I see involve absolute total shenanigans that the entrepreneurs are just stunned by when it hits them. I have been with more founders bawling their eyes out because their deal imploded on them in the last 3 years than not on the successful M&As. And the pressure and stress. And so my overall thing on M&A is the only advice that's really valuable is advice from someone who's recently been through it, preferably without a financial stake in your company. Maybe they're an angel, and sometimes those help, but founders need to dramatically level up their intentionality of their preparation going into M&A.
You've got a background with prop tech.
Mm-hmm.
For the most part, you're focused on AI investing today. I'd love to talk about the AI piece first and then come back to prop tech. But what led you to focus so heavily on AI today?
I've done lots of investing in lots of sectors, and I generally enjoy it. I think I'm a pretty good founder picker. And so at a check size and a portfolio size where picking great founders is what leads to the great investments, I'm pretty well practiced. I read 8,000 YC applications. I took my notes from Paul Graham on how to do it well. Investment firms are two sides. It's being a stewardship of other people's capital and being an investor in the startup. And of those two sides, when I'm angel investing, I angel invest in whatever I thought was most interesting. One of my best ever angel investments is Bella Beat, and they make women's health devices. I got it because I thought it would be a nice gift for my wife. That's why we invested.
You should get her more gifts.
That's right. But I think in the world of being a steward of other people's capital, it's super important to really identify what is a superpower you have that is so much better than everyone else's. You have a shot at being an outlier return with their money. And I think venture capital world, where median results underperform putting your money in treasuries, it means you have to give a shot at becoming top quartile or top decile or top 1 or 2% return. And I raise money from people who I've known for 10, 15 years, who backed me before. I raise money from close friends. I know those close friends are counting on the capital to be part of college education investments. I really care about providing a return to other people who entrust me with their money. The superpower we figured out with Orange Collective is within Y Combinator, we can get a meeting with any company in the batch just by being alumni and by being good people with good reviews. That's table stakes. Lots of people have that. We know how to use other people's software in our own software and in our own companies. We have 150 YC alumni that are investors in Orange Collective. and using another company's software and interacting with that founder as a user with feedback, it is, I would say, without a close second, the single best way to evaluate a founder. Try to come up with a better proposition for evaluating an investment. And at the YC level, it's a founder investment. Try to come up with a better way to evaluate a founder than using their software and interacting with them as a user. I don't think you can do it. So we have that type of interaction with YC founders that are in the batch, and that allows us to come out with extremely high conviction yeses. We don't have high conviction nos ever. We have companies who are like, well, we're not at a high conviction yes yet, but they didn't pitch us, and we didn't have to come up with an answer yes or no. But when we interact with a company, I'll give you an example. We are investors in this company, Mastra AI, which makes an AI framework for TypeScript. 19 of our YC alumni LPs installed the framework and started using it, and we made it like a part of our little AI agent memo. We were so enamored with their approach to the software, the founders' responses. We're giving them bug requests nonstop. We're in the Discord server, like so deep in the development of this software. It was easy to be a high conviction yes. Being a high conviction yes means you get allocation in the companies you want to get allocation into. We get about a 50% discount on price by being early, because founders generally raise the cap as they get more popular. Founders never forget the investors who invested before they were hot. They remember if you help make them hot. And investors never forget the other investor on the cap table that introduced them. And we are generally the first check YC founders take after YC itself. On almost all of our investments, we're the first. Maybe there's a few 50K checks ahead of us, but we're a 300 to 600K check. We only make 3 to 4 investments per batch. So we're not an index fund. And the founders, investors, they don't forget that we were there like that. And it's only a few weeks earlier than the rest of the round. But in the future, there will be pro rata decisions to be made. And if we introduce the investor who got the lead position through that introduction, we're going to get pro rata. In the future, there will be accesses to data. Sometimes seed investors lose access to data. We will have a pretty compelling reason. Our WhatsApp group with each group of founder has got 70 messages deep on it by the time they finish their seed round. Other seed investors who came in during the normal fundraising period, they probably just met once, said yes, and got in, but they don't have this deep relationship. So all of that is about building a relationship with the founder. And what we found is if you're not super focused on what they're building and deeply understand why what they're building is powerful, you don't get to have that type of relationship with them. So the AI focus, man, it's like whenever we see a non-AI company that we really want to invest in, we're like, we hate this constraint on us. We wish we could just invest in everything. But we made a couple of biotech investments and space tech investments and hardware investments in the past years of Orange Collective being together. And we just found that our all-in relationship and materiality to that company was lower. And we're like, we shouldn't be doing that. It's not the highest and best use of what we can be. And one of the things I didn't anticipate happening, but is now happening, is top tier AI thinkers want to be involved in the fund as LPs, and we connect them with the founders, and both sides love that little matchmaking moment. One of our companies is Airweave, and they create this really important layer of the AI stack, which helps the AI agents figure out which chunk of data to go use to answer its question so that it's not using an infinite context window in every single search. Think of it like RAG for AI agents. I'm not sure that X for Y works. But we have the actual team at OpenAI who's building the same exact thing at OpenAI, and we connected them. And our investment is the open source version, and OpenAI is doing it on the background, and they're sharing back and forth. It's just like an amazing connection to understand this level of infrastructure. And those types of like connections happen because we didn't say we're like a Y Combinator focused fund to invest in the best YC companies. We said we're this AI fund that like we will be very in depth on the infrastructure of AI. And that attracts a lot of big AI thinkers. And the other thing I tell both our founders and the LPs is YC was not built to be an insiders club. If it feels that way to you, or it feels to you like you're on the outside, Paul Graham made it so that anyone could apply for YC money by filling out a form on the internet. And you didn't even need to do a PowerPoint deck or a business plan. He wanted it to be access without a network gets you in. And I tell investors, that is why Combinator's thesis as well, is that if you're a builder who supports other builders, you should be able to invest in any of the YC companies. That's what Demo Day is. It's easy access. And all of our LPs are all AI thinkers, or they want access to AI companies. And we tell them, use Orange Collective just to get access to the batch. And I guess maybe the final thing I'd say on that question is constraints help people. Like we are way, 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 way better a constrained venture firm than a generalist venture firm.
Open source is another theme from some of your more recent investments. May not be the lead thing, but it's noticeable. What about open source interests you from a business model perspective?
One of the big challenges investing in AI is the platform shifts around you, the OpenAI, Anthropic, XAI, Gemini, like where your startup lives within these underlying large model dependencies and shifts. It's a little bit like investing in an app over the run up of iOS and Android. If you invest in an app that just in the end makes more sense to live at the operating system level, then you as a company have this like ever-present existential risk that you can't do anything about. And we see that a lot with companies we would love to invest in and have amazing founders and amazing traction today. But we ask ourselves, like, does it just make more sense for this to live as like a ChatGPT portion? Would we as a user more appreciate it to just live inside of ChatGPT? That's a really tough question to answer. And open source provides a method to have an answer to that question. It says there will always be open source versus closed source battles. And there's a progression of a technology over time where closed source gets ahead in the early days, but open source has this like really long route to winning and wins really big. So we know this from many generations of platform shifts. So when we look at some of our open source companies that compete head on with frontier models and their closed source version, like browser use competing with OpenAI's operator, we look at and we say the one thing we know about browser use is open source is the advantage that they get in addition to trying to out execute. So they're at 65,000 GitHub stars right now. One of the fastest growing GitHub stars company in the world ever. And it's a reflection of the fact that the world of developers needs an open source version of how AI agents access the web. That's going to be a critical portion of the whole infrastructure. And the world needs there to be an open source version. So now what they have to do is be the best open source version. There's no prize for being second place. And the abilities have to be materially better or on par with what you can get in closed source version of, living within one of the frontier model stacks. But both those things mean it's in their control. And now if we pick the right founders, they can get to a huge outcome. without some existential risk shifting underneath them. They need to ship faster. They need to ship better. They need to build their developer community, but they won't ever have this like, oh crap, iOS launched a new update and our company's now dead moment. If they lose it, they lost it themselves. And so I'd say over half the portfolio is open source. The other thing we really like about open source, we get to evaluate it real easily. It's like all of our advantages play. For those investors who don't have engineers in their investment team, they're not in there in the open source repos, and we get to be there earlier. So it's like a huge advantage for us. We absolutely believe there will be decacorn AI companies coming out of YC batches right now that we will miss. A lot of them will be consumer, and we're open to doing consumer. We don't have to like use software as our only investment thesis. It's just one of our advantages, but it's much, much, much harder for us to do what we do, which is a high conviction early yes on consumer. It's really hard. Any batch, there's 30, 40 companies who are probably worthy of that. And some investor will pick theirs. And for whatever reason, years later, like the old Robert Frost poem, they'll say, that was what made all the difference. But I tend to look at it and I say, look, I, like you, will later on say that I had believed in the founders, and that's why I invested. Within a Y Combinator batch, 150 companies, 350 to 400 founders, I can get myself to, this is an amazing founder, unlike literally all of them. They got through a YC interview. I can say they are a uber top tier, Alexander Wang, like Scale AI style, top tier founder potential person on like 150, 200 of them. So it's hard to pick if you're only making 3 to 4 investments per batch. It's hard to use that as like your only thing. And famously, the YC partners for years were asked by PG to kind of rate the founder's potential. And it was like all tracked within the original news.ycombinator.com software. Very little correlation from almost all of them on picking who's actually the next Patrick and Jonathan Collison. Like a very, very, very little correlation, just because the potential amongst all of them is so high, and it's just hard to tell who will emerge as like this amazing founder. But with open source and AI, at least we get to say, look at this slope. Amazing founder plus look at the slope.
What's a conventional view in venture that you think is BS?
My favorite one, ownership percentage minimums. Nothing has destroyed more value than LP religion around ownership percentage minimum and GP religion about ownership percentage minimum. Nothing has destroyed more value.
Because they bid up too much, or they walk from deals where they would have been better off if they just taken a smaller allocation, or both.
Let's talk about why LPs believe so much in ownership percentage minimum. They invest in 20 funds. They look at the funds that were most successful, and they find that they had an investment which had a meaningful ownership in the beginning. And then that meaningful ownership in the beginning emerged as an outlier. They look at all the other funds that didn't do as well, and they don't have meaningful ownership in their best company, which leads them to a very clear conclusion, which is you have to have meaningful ownership because you don't know which company is going to be the outlier. That's the truth. That's correct. GPs don't know which of their investments for the first 2, 3, 4 years will be their meaningful outlier. So you at least have to have meaningful ownership such that whichever one is, like then you'll have a meaningful fund. That's where it comes from. They don't include in their retrospective analysis whether having meaningful ownership minimums led to those case examples having that investment. They introduce adverse selection with ownership minimums. And if you invest in a fund manager who, was doing small checks where like, fund one, the ownership minimum didn't matter. Fund two, it got bigger. Fund three, it got bigger. You're introducing an adverse selection to a manager who hasn't had this requirement before. So now let me just paint the picture from the other perspective. Me watching fellow fund managers try to invest. I've been to every demo day since 2009. I've met with maybe as many companies as like anyone else on the planet, definitely within like a very small number of peers that have met with as many companies as I have. Most of those peers are index funds who don't have ownership minimums. I have seen my fellow GPs who raise funds that have ownership minimums. Maybe they're on their fund two or fund three. And I've watched them develop from angel investors to fund managers without ownership minimums to fund managers with ownership minimums. And I know exactly what they're doing. It's the only thing they can do. They meet with companies and their first check is whether ownership minimum is available. Previously, they were just investing in the best companies. That's what got them their track record. Now they're selecting only for the investments in which they got to them at a moment in time in which 5% or 10% or 8%, whatever their like LP promised ownership minimum is. And that's where they're putting the check in. We rank the batch. That's what we do. We're trying to get into 3 total companies, 4 total companies. We have all this ranking software. I know for certain these managers are not getting into what they themselves perceive to be the best in the batch. So that's what ownership minimums do. They introduce adverse selection, which changes GP behavior, and it has them target companies that they themselves believe are not the best companies. All because of this like false analysis. Now, what the analysis should be is we want to invest in the best companies we can get access to with the most amount of capital into those companies as we can. That's what it should be. And whether we end up with one fund that has this amazing outcome on one company and this other fund that has 2 amazing outcomes or 3 amazing outcomes, we as an LP should look at it from a portfolio perspective, which is what is our number of outliers per dollar invested? That's how you should be measuring it. LPs have stopped doing portfolio theory across their funds. And they're maniacally focused on this like one outcome with one ownership percentage will produce the outcomes of that fund. And so you look at the returns across VC and they're awful. Median is awful, especially for the illiquidity penalty you're taking. And I think it's 100% due to this one issue. Now, I know this because I've talked with Gary Tan about it. He has, these amazing returns for initialized fund 1 and 2, which has Coinbase and Rippling in them. He has said that ownership minimums had cost him billions. I know because I've talked to Liquid 2, who raised one of the first ever large index funds, that no one believed that a 250 portfolio company would be able to produce the outcomes it did. And they had 19 unicorns in that 250 company portfolio. Amazing returns. I know that SV Angel was able to produce 12, 14, and 16x TVPIs with half of it already DPIs. So I know for certain which strategies work and which strategies don't, but you cannot convince an LP to go to move away from their ownership minimum. And so what they get is they get a portfolio of companies.
They get ordinary results.
They get ordinary results, and it just continues.
Well,
And I remember when I was a
strategy,
founder in
ordinary
2009,
results.
Sequoia was like, if we can't do 25%, we won't invest in you. So like, it goes back 15 years, people believing this. Now the investment firms are like, if we can't get 8%, we can't do it.
Love it and agree. Well, I'll wrap it up there. This was really fun. I love this conversation. I look forward to staying in touch, and hopefully we'll have you back on at some point in the future.
Thanks, Joe. Appreciate it.
Awesome. Thanks, Jason. Hi, Joe again. Thanks for watching the show. If you'd like more of this in the future, subscribe to our channel. If you'd like to learn more about Seaplane Ventures, just check out seaplaneventures.com. Cheers.